Investing in the stock market is a tried and true approach to making your money work for you as you endeavor to generate more money. Warren Buffett, a well-known investor, said that investing means giving up consumption now so that you can consume more in the future. If you consistently invest your money, you can multiply it several times over time. This is called compounding, a concept I call the eighth wonder of the world. More about this in a later video. Because of this, it's crucial to start investing as soon as you have any money set aside for the purpose. Furthermore, a fantastic place to start is the stock market. In today's video, I will be sharing all I have learned about stocks. This is the Finance Professor channel, where we teach you all about the stock market, personal finance, and building generational wealth. Click the subscribe button to join this family. Now, let's begin. You can begin whether you have $1,000 saved or can afford an extra $25 per week. Remember that there is a lot you can and should learn about stock investing if you want to succeed financially. For the time being, read on for the procedure's first phases. What is your risk tolerance, or how willing are you to take on the potential of losing money if you invest? Stocks can be divided into several categories. Value stocks, aggressive growth stocks, high capitalization stocks, and small cap stocks. There are varying degrees of risk with each. You can invest in stocks that fit your risk tolerance once you've determined how much risk you're willing to take. Determine your investment objectives as well. An online broker like Charles Schwab or Fidelity will ask you about your investing goals and the previously mentioned level of risk that you're willing to take when you open a brokerage account. If you're just starting out, one of your investment goals could be to accumulate funds in your account. When you're older, you can make money as well as build and protect your wealth. While some investors like to set it and forget it, others desire to manage their money actively. Though your choice could vary, choose a strategy to get going. If you're confident in your knowledge and skills in the field, you can handle your investments and portfolio on your own. You can invest in stocks, bonds, exchange-traded funds or ETFs, index funds, and mutual funds using traditional internet brokers like the two described above. Don't stress if you are new to stock investing. A seasoned broker or financial advisor can help you choose investments, manage your portfolio, and make changes to your portfolio. This is a great choice for people who don't know much about investing but know it's important but want help from a pro. Diversifying into individual equities might be challenging if your budget is tight. For instance, you can only invest in one or two businesses with $1,000. There is a higher risk as a result. Mutual funds and ETFs can be useful in this situation. Both types of funds frequently hold the majority of stocks and other investments. As a result, they offer greater diversification than a single stock. Several banking institutions require minimum deposit amounts. In other words, once you make a particular number of deposits, they will accept your account application. It benefits from comparison shopping rather than just learning the minimal deposits. Typically, your broker will charge a commission each time you trade equities, whether you purchase or sell stocks. Trading commissions can be as high as $10 per trade or as low as $2. Some brokers don't even charge trading commissions. Instead, they make up the difference in fees. Depending on how often you trade, these costs may stack up, impact the return on your portfolio, and reduce the amount of money you have available for investment. Mutual funds are pools of money from investors that are managed by experts and put to work in several markets. It would help if you were informed that they charge various fees. The management expense ratio is one of them, or MER. The MER is a fee that mutual fund or ETF shareholders must pay, and the money goes towards the costs associated with maintaining the fund. Sales commissions may also be referred to as loads. Both front-end and back-end loads are examples of these. Before purchasing a fund, know if it has a sales burden. To avoid these fees, look at your broker's list of no-load and no-transaction fee funds. Mutual fund fees might be easier for new investors to deal with than the commissions you have to pay when you buy individual stocks. Additionally, you can start with a fund for less money than you would like pay to buy individual equities. By minimizing the effects of volatility, Consistently investing small amounts over time in a mutual fund can provide you with the advantages of dollar cost averaging or DCA. Full-service brokers, as their name suggests, offer a wide range of traditional brokerage services such as help with estate planning, planning for retirement, planning for college, and planning for other life events and possibilities. The personalized help they offer makes up for the fact that they normally charge more than other brokers. These can be a percentage of your transactions, a percentage of your assets under management, or sometimes a membership fee you pay once a year. Minimum balances can begin at $25,000 per account. Discount brokers were unusual in the past but are now commonplace. You can choose your investments and place your orders using the tools they provide. Some also provide a set it and forget it robo-advisory service. On their websites and mobile apps, many businesses have learning tools that can help new investors. Some brokers have relatively lax minimum deposit requirements. They might, however, have additional conditions and costs. As you search for a brokerage account that satisfies your stock investment requirements, make sure to look into both of these. After the 2008 financial crisis, a new type of investment advisor called a robot advisor appeared. John Stein and Ellie Broverman of Betterment are often called the field's founders. Their goal was to use technology to simplify investment advice and cut costs for investors. A stock market simulator can be useful for people new to trading who want to practice without jeopardizing their own money. A large number of trading simulators, both paid and free, are available. The use of Investopedia's simulator is free. Users of stock market simulators can invest fake, virtual money in a portfolio of stocks, options, exchange-traded funds, or other securities. Most of the time, these simulators keep an eye on how the prices of investments change, depending on the simulator. They may also keep an eye on other important factors like trading costs or dividend payouts. Investors carry out virtual transactions as though they were carrying out actual transactions. Users of the simulator can use this method to learn about investing and see what happens with their made-up investments without risking any of their own money. A further motivation to make wise investments is the ability to compete against other users in some simulators. Remember, investing is a commitment to put money down today to achieve a financial goal. There are many ways to classify risk, and some asset classes and financial products are inherently much riskier than others. Risk is a component of all investing. There is always a chance that your investment's value will stay the same over time. Customers typically pay commissions to brokers for each trade. These charges may exceed $10 for each trade. Investors typically believe it is prudent to keep their overall number of trades to a minimum to reduce their exposure to commission charges. Exchange-traded funds, among other investment options, charge fees to cover fund management costs. You can invest in stocks with a fair amount of cash if you're just getting started as an investor. You will need to do some research to figure out your investment goals, how much risk you are willing to take, and the costs of buying stocks and mutual funds. Additionally, it would help if you research several brokers to see which might best meet your demands and to understand their unique requirements. Once you do, you'll be in a good position to benefit from the significant financial upside that stocks can offer you over time. That is all for this video. We will be back soon with another informative video. Don't forget to subscribe, like, and share this video. Please activate the notification button to get notified when we post the next video.